Hi everyone, and thank you for tuning in. In this video, I'm going to answer the question if Coca-Cola stock is a buy. I'm going to be using a simplified version of my 6-step framework for analysis. So let's jump right in. The first step in my framework is customer value, and Coca-Cola offers great tasting beverages at affordable prices in plentiful locations worldwide. They offer customers multiple package and bottle sizes to match your taste. So you might go into a store just looking for an individual sized can, or you might be looking to buy a 24 pack for a party you have this upcoming Sunday. Regardless of your needs, Coca-Cola probably has a size and package to fit what you're looking for. The next step in my framework considers unit economics, and Coca-Cola has done a masterful job here. Decades of earning excellent margins in its core business of selling beverages. Gross profit margin averaged 61% in the last decade. Operating profit margin 24%. Incredible margins and a long history of delivering these margins consistently. The next step in my framework considers the total addressable market. The non-alcoholic beverage market is estimated to reach 1.25 trillion globally in 2022. Not only that, but it's estimated to grow at a compound annual rate of 7% from now until 2026. That means in each year, the market's going to grow by at least $70 billion. Why is that really good for investors? Because if there's new entrants coming into the market, they could step in and take some of those $70 billion in expansion that the market is experiencing. A new entrant doesn't need to take market share from existing players when the market is growing this rapidly. So that's great news for investors. That means when there's new companies coming in, Coca-Cola won't be at risk of losing its market share. The next step in my framework looks at competition. And for the beverage industry, and primarily I look at the beverage industry looking at Coca-Cola and Pepsi because they are the two biggest players. So they're the leaders in the market. I want to see how they're leading the market. And I like what I see here. Discounts are rare. They're not competing with each other to lower prices. So it's not like PepsiCo sees Coke selling at $1 and they lower their price to 89 cents, and then Coca-Cola responds by lowering their price to 79 cents, and all the while that's eating into profit margins. That's not the case. They actually just set the price and they stick with it. They don't battle each other on price. And there's evidence of that when you look at, earlier I mentioned Coca-Cola's profit margin averaged 60% consistently over the last decade. So it's not like its profit margin was fluctuating and averaged 60%. It was relatively straight line between 59 and 61% in the last decade. So very stable industry with little competition on price. I love to see that as an investor. That's one of my favorite industries to invest to consider because of this stable competition. The next step in my framework looks at valuation, and for Coca-Cola, I looked at the price to earnings ratio and the price to free cash flow, and for each they had 24.7 price to free cash flow and 26.3 in the purple for price to earnings. And if you look back in the last 3 years, it's about the average price for Coca-Cola in the last 3 years. So it's not like the stock is cheap by any means. The stock is not cheap. It's not expensive, but it's also not cheap. It's right about in the middle. I would say it's average priced. Okay, the final step in my framework considers risks, and the primary risk I list here is a long run risk, which is the global fight against sugary beverages. And Coca-Cola is going to face this risk for several years, maybe decades, because This has been ongoing, and I don't see this trend reversing. There's a lot of sugar in Coca-Cola's beverages, a lot of calories, a lot of carbs, and consumers are shifting more towards healthier beverages, and this could work against Coca-Cola. Now, that said, they're working to expand their portfolio to include healthier choices. Still, a big part of its sales come from these drinks with big sugar component, big carb component, and so we don't know how quick that reversal will be and if their healthy choices will rise up to offset those losses in the sugary drinks side of its business. The other risk is rising costs, right? We hear about this all the time. Inflation is rearing its ugly head, and that's raising the cost for materials, labor, transportation. All in all, that could pressure Coca-Cola's profit margins. Although I will give them credit for, decades of history of performing in these types of scenarios, and so maybe they've got a solution for this. Maybe they have a formula to address these elevated costs better than maybe some of the younger companies that don't have as long a history as Coca-Cola does. And finally, there's a pending legal case regarding its taxes where a negative ruling could cost Coca-Cola billions in tax payments. This is a risk to look out for. Shorter term in nature, along with the inflation and rising cost risk, where the global fight against sugary beverages is a longer term risk. Okay, now that I've looked at each of my segments, let's look at some grades that I assigned these segments. So the first step, customer value, I gave Coca-Cola an A minus. They deliver tasty beverages, affordable prices, several choices, right? So you can choose a bigger size if you want to get lower cost per ounce, or if you want a single serving, you might pay more cost per ounce, but you just want one for yourself. You don't want to buy a whole 24 pack. The next step, unit economics, I gave them an A plus. Remember, I talked about its excellent profit margins, long history, A plus there. Total addressable market, A plus. Anytime there's a market size over $1 trillion, it's an automatic A plus from me. Competition, A plus. Remember, I talked here about stable history with the two leaders in the market. They're not competing on price. They get an A plus there. Risks, I gave them a C plus. The legal risk could cost it billions of dollars. The long run risk against sugary beverages is uncertain how big that impact could be. And inflation is volatile, and I don't know how big how much of an impact that's going to have on profit margins. So C plus in terms of risks. And then valuation, I gave them a B minus. The stock is not cheap in an environment of elevated risks. I would like to see a cheaper stock price, so right now I gave them a B minus for valuation. So now that I've looked at all of the 6 steps in my framework, assigned it a grade in each of the steps, it's time to answer the question if Coca-Cola stock is a buy. It's right on the borderline. Coca-Cola, excellent unit economics, marvelous total addressable market. I love the competitive forces in the industry. However, the higher risk and the not cheap valuation makes me put this right on the borderline. Maybe a 5 to 10% pullback in the stock price will push me above the borderline to recommend the stock be a buy. So it's right there on the borderline. In this volatile investing environment where the broader markets are entering bear markets, investors have the luxury of waiting. So wait, give Coca-Cola a couple of weeks to a couple of months. You might get a cheaper entry point to purchase the stock and give you a margin of safety there to withstand some of these risks that it's facing. Okay, so that's all I've got for Coca-Cola stock. Let me know what you think in the comments down below, and tune in next time for my next installment of Is This Stock a Buy? I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for all investors of all skill sets and risk levels. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 3 times. Go to fool.com/parkev to get your 10 stock picks now.